Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome to the weekend edition of the KE Report. Corey and Shad here, your host for this weekend show. In this weekend show, we're going to be focusing on resources, commodity investing, starting off with a big focus on the energy sector because, well, this war in Iran continues to dominate the headlines, and it's also dominating what's going on, especially in the oil price and some of the oil stocks. A lot of oil stocks continuing to melt higher, and I think the biggest confusion that I have is actually what's going on in this war. We keep getting, it seems like, conflicting stories, but what I'm watching is if this war seems to be slowing down, and right now it doesn't seem to be. So who knows when it's going to end, but we do need to, I think, have a game plan for if this war continues and if it stops in the near term, what the trickle through could be and how quickly energy markets could correct. That all being said, we are chatting with Josef Schachter. Josef is the founder and editor of the Schachter Energy Report, also writes the Ion Energy Report. That is on Substack. The Ion Energy Report focuses more on the macro energy prices. Schachter Energy Report dives into the stocks. Josef, look, we're kicking off the show with you because I want to get a little bit more clarification, or at least your thoughts on what the trickle through of this war in Iran will have on energy prices. Look, oil, as we're recording this, about halfway through the day on Tuesday, is in the 90s. It's been volatile, but quite frankly, it's holding at higher levels. I know some people are out there trying to short it, thinking this war is going to end, but that's been kind of a losing trade. However, oil is off of some of its highs from when it spiked up to 120. Josef, just make sense of this Strait of Hormuz issue. This seems to be the biggest issue here, where so much oil and even natural gas is shipped through this strait, and its impact really globally on the price of oil. So give us kind of your data on the Strait of Hormuz, why it's so important to the energy price, and what the longer term impact could be of essentially a shutdown.
Yeah, let's put the numbers in context. Global demand is about 106 million, 106.1, 106.2, depending upon, whose estimates you're using. And 20 million barrels comes out of the Persian Gulf. So it's a good percentage. And it's a big percentage mostly for Asia and mostly for Europe. So the United States, as we all know, is self-sufficient, 23.7 million barrels produced, 21 consumed. So they're a net exporter. We export. We're a net exporter to the United States and more through TMX to Asia. So the Straits of Hormuz is important for both oil, for natural gas. Qatar, there's been attacks against the fields there, and they've had to shut in natural gas production. As you shut in natural gas production, you also shut in sulfur, and the 25% of the global sulfur that's used in fertilizer also is not moving. So you've got a problem with the cost side on planting by farmers. And this is the time of year that you start doing it. So that means that, a potential doubling in the cost of fertilizer. So can farmers afford it? And if they can't, then the yields will go down, and that means food prices will go up. So let's talk first about President Trump says that the Straits of Hormuz are open. Yeah, it's open to China and Indian, buyers of Iranian crude and any of the ones that Iran says will let through. But if it's anyone that is not, they don't let you through. They are still attacking with drones, commercial, crude carriers and ships carrying, the big, structural components and fertilizer and, cargoes. And so we've got a problem here where until we don't see for a couple of days in a row where there's no drone attacks, no attacks on facilities, ballistic missile attacks in UAE or Oman or Bahrain or Saudi Arabia, the owners of the 800 ships that are blocked in this area they're not going to go through because the owners are going to say, no, I can't afford to, lose my ship. I can't afford to lose my personnel. So until you see no attacks or so few that people will start saying, okay, I can take the risk, I don't think you can say the war is over. And if this thing is the same 2 weeks from now, that's not going to be good. And if it's a month from now, it'll be very not good. If it's 2 weeks from now, $96 today becomes 110 to 120, back to the highs that we saw just 2 weeks ago. And then I think the big problem becomes if this is mid-April, late April, and we're still doing the same kind of attacks and the same volume of attacks, same problems, we could be pushing above 120. The all-time high, 147, which we made in the summer of 2008, if this thing continues into June, July, we're going to even blow past that because by then inventories will go down. Let's put inventories in context. We have 90 days of inventories right now. That's going to go down, of course, in the next issue, and it'll be going lower every month from now on because the Russian crude is being used, Venezuelan crude that was in their shadow fleets is being used. So the lowest level we ever had was in 2008, and we were down to 79 days. And so we're 90. So if we get to 80, 84, then that's going to be a warning. If we get below 80, that's going to be really problematic. And on the other hand, if you go back to COVID, when the economy shut down, we went up to 120 days of inventories. And then 6 months later, we were back in the low 90s. So to me, I'm watching days of inventory. And, the crude stocks are doing very well because the days of inventory really look like they're coming down and the prices are very strong. You can't hedge out far because of the nearby futures are high because of the, expectation the war is going to end early. If the war does not end quickly, then the price curve will continue to rise. Right now, if you wanted to do November of 2026, you might only get in the mid 60s versus you might get, mid 90s on the next contract for WTI. So I think we need to see, the war end for things to get back to normal. The energy stocks that are oily have done exceedingly well. And we got with 52-week highs in many of them. Right now, my comment to our subscribers is if you have an investment position that you bought and was 4 or 5, and now it's 10, 12, 14%, it's only prudent to pull some of that back, build cash reserves on those names. And if people are saying, well, what's still worth buying? I would say natural gas stocks. Natural gas stocks have not lifted at all or even only a small amount. And so I believe that natural gas will do better, later this year and into the outgoing years as more LNG plants come on, as more, the problem with Qatar is going to set up the European and Asian gas prices will be high. And so, if you have an ability to move your gas, we're going to see higher prices. So LNG Canada is finally getting to, the 2 BCF a day. That should strengthen prices from the summer through the fall. And then, of course, winter of 26, 27, we could be looking at $3 to $4 AECO, and you're probably looking at $4 to $5 for NYMEX.
All right. So a lot to dive into there, Joseph. Could be a contrarian play on the nat gas stocks right now, especially if things start catching up there. There's some big spreads between what we see in North America and what we see in Europe or Asia. So a big delta there to capture. As far as the oil prices, if they get to triple digits, of course, that's going to be a net positive for energy companies. My question is, before we dive into all the companies, Joseph, what would triple digit oil prices do to the economy, to inflation, to consumers at the gas pump, to businesses that rely on freight? What does that do to inflation, CPI? So just from a effects, what would that mean to the economy? Any thoughts there?
Yeah, Shad, what we're seeing now from more and more, if you watch Bloomberg, Business, or you watch CNBC, even, Bloomberg Canada, BNN, they're talking about the longer this lasts, the higher the probability of global recession. And so if that happens, maybe that 106.1 number I'm using for global demand this year may not be the case. Last year it was 105.1. So I'm losing 1 million barrels more. If it's a global recession, maybe there's no demand growth. That would then push the price of oil down after the war is over, even more so than, people might have thought okay, we're 96 today, the war is over, sometime in April, do we go down into the 70s and then, move around in the 70, 80 range for a while? If you know from our prior discussions, I was using for 2026 $70 average, and our view was in Q2 that OPEC production would show that they can't increase production. That would wake prices up into the 70s. And in Q4, as we saw global inventory shrink, we would get into the 80s. All of those forecasts are out to lunch now. They're not going to be there. Right now, I would probably say we're looking at an 80 number for the year on average. And the question is, where are we going to be in Q3, Q4? And again, how far is the war, and how big are inventory? So, if somebody asked me to give a fearless forecast for 2026, I can't, because I don't know what global inventories are going to be at the end of the war. Once I see that number, and number of days of inventory, then you can start coming up with a prediction.
So, Joseph, one thing we keep hearing, or I hear about the U.S., is that they're energy independent. So they can supply all their citizens with the oil that they need, but still, the price of oil could move higher, and that impacts Americans. Any changes on the supply dynamic just coming out of the U.S. to either take advantage of these higher prices or somehow, I guess, put a Band-Aid on this war and its impact on other countries?
Well, the United States doesn't have a problem for themselves, but it's a global commodity, so it trades on a global basis. So, if you look at last week, we'll get another report on next Wednesday or tomorrow. They were 13.7 for domestic production, and that's up 103,000 from 2025, on the same week. And then you had 9.99 million barrels of natural gas liquids and renewables, and that's up 570 from a year ago. So the U.S. not only is self-sufficient, it's, the Permian with all the liquids-rich gas, condensate and propane and all the other things that are coming out of it. They're self-sufficient, and the consumption last week was 21.2 million barrels. So you're looking at, as I said, 2.4 million barrel surplus. They exported last week 3.4 million barrels, and they imported 6.4, and of that, 4 million comes from Canada, because they need our heavy oil in their refineries, and the light oil coming out of the Permian is what's getting exported. So, but the problem is it's a global commodity. Tankers can move it around everywhere. So the U.S. is paying at the pump the higher price for fuel, for gasoline right now, and diesel because of that. The natural gas price is a domestic price. If you have a locked in, continental situation, and you have not an extra ability to move it to Europe or Asia, which is effectively the lock-in for Canada and partially for the States, because they're producing 20 BCF a day and they're moving it, but they could probably move 30 or 40. And right now they're building facilities to get to 30 BCF by the end of the decade. So, if you have stranded gas, it's trading cheaply, as AECO and NYMEX are. And we'll have to wait. 310, 312, I think, is NYMEX today. And I mentioned earlier, $1.85 for AECO. So these prices are landlocked prices. But on the other side of it, oil 96. And remember, the Canadian oil trades, because a lot of it is heavy, so there's a discount, but then multiply that by the Canadian dollar, 1.37, and that's why the oil stocks are running, because the amount of cash flow they're going to get in Q1 is going to be much higher than Q4 and much higher than Q1 of 2025.
Joseph, there's been a lot to do about the strategic petroleum reserves being released kind of as a Band-Aid, but what is your thoughts on how long they can play that game? Because I thought they were still working on filling them up at one point, and now they're releasing it all. When does that effect run out? Does it have that much of an effect? And at what point does it become a situation where inflation gets so big this starts interrupting central bank policy?
Well, I think central banks, always seems to use the PCE, and they X food and X energy. Well, you can't X food and X energy. That's the affordability issue where the Democrats are beating up the Republicans right now. And affordability is still going to be an issue. So I think that, food and energy are going to be rising. The Fed is going to be boxed in. Stagflation is the word that people will start using because the economy will be slow or slowing and going negative, and inflation will be rising. So it's going to be what we saw in the late 70s. And then, of course, we needed Paul Volcker to come in and beat the with other central bankers to beat up the inflation. So, to me, the inflation worry is real. And right now, affordability is there. Mortgage rates have gone up in the United States. The 10-year yield has gone up 20 beeps almost in the last few weeks. We hear more and more about private credit being a problem in the United States. Spreads on junk bonds versus quality bonds are widening. This to me in some ways looks like 2008. It was the leveraged bond situations and the housing issue, and but we also have derivatives that could be a problem, and we don't hear much about that anymore. But everybody talks about the size of the derivative market, and if somebody doesn't trust somebody like they didn't trust Lehman or Bear Stearns, all of a sudden game over. So I think that there's a lot of reasons to be cautious here. It doesn't mean not to be invested, but as I mentioned, if you have oil stocks that have doubled or tripled and they're way out of position relative to your norm of weightings, it's only prudent on portfolio management wise to do it. And if you want to reinvest, then my comment is, if you want to reinvest in energy, then look at the natural gas name.
Joseph, so we will get to the natural gas names, but in terms of the oil names, should we expect any of these companies to increase production to try to take advantage of these higher prices here and now?
So far, on all the conference calls that I've been on, we have not heard anybody saying that. What they're saying is, if they, remember, a lot of these companies put in hedges at lower oil prices. So the amount that's hedged is not getting the benefit. They might have $60 to $70 collars when we're 96 US, and that might be, let's say, 115, 120 Canadian. So they left a lot on the table on the percentage that's hedged. And all you can do is hedge out a month or two at these high prices, or sell it at the spot market, which is what a lot of them are doing. The cash that's coming in, I think companies are going to use it to continue to improve their balance sheets. Many of them still have debt issues. Others are, are good financial shape. If they think their stock is cheap, they're doing NCIBs. Many of them are paying dividends, and they just, make the dividend, cover that much stronger. And for conservative investors, you can still find yields in the 6-7% range in the market even today.
Well, Joseph, I'm glad you got into the hedging, because we've had a couple of people send in questions about this. You've already mentioned the forward curve is still not anywhere close to where pricing is today. It's a lot lower. But as that starts creeping up, what percentage of companies do have things hedged as far as the research you've done, and to what amount? Because most companies, it's only a partial hedge. Any information there you can share?
The lowest that like there's some that are totally unhedged, and there's others that are 20, 30%. I think some can go up to 50 with their board approval. And if they want to go above it, then they have to again go to the board to get an increase. So 30 to 50 seems to be about the number, both for oil and for gas. And if you can add additional hedges, again, you just get a quick board meeting and say, look, we're sitting at 96. We can hedge into May or April. Let's do another 5,000 barrels. And if the board votes yes, then that can happen. But nobody's going to go 100%. If you go 60, 70, that's as far as prudence would allow you to do it.
Joseph, how do we find out how these companies are hedging? If they are hedging, what their hedges might be? Is it simply just the kind of earnings reports, or is there something else we can look at to figure this out?
Some of them have it on their websites, and others just report it in their quarterly reports. We're still going through the, let's say that, the 2/3 of the way through the Q4 2025 report cycle. And so between now and let's say the end of the month, early the next month, we're still going to be having companies reporting. So that's where you can get all the information on your company, see what they've done for hedging. One thing I recommend, and we've talked about this before, is if you own a company and they do quarterly presentations, webcasts, go and listen to the webcast, because not only do you want to hear what the company says, but you want to listen to what the analysts are asking about the portfolio managers on the buy side, asking management, because what's on their mind will probably be what's on your mind and you can hear somebody ask that question and get an answer from management. So that's really great value. FaceTime with management and hearing what they have to say.
Joseph, do you think right now that the companies that are the most unhedged are actually the ways to play it because they can benefit from the crazy price swings to the upside? Are there any companies that stand out as being less hedged or unhedged that maybe have more torque right now?
There are some that are, let's go through those that are oily. Freehold Royalty, I don't think they do much hedging. Paramount, 53%. Again, not so much there. I'm just going through my numbers. Whitecap, 61%. They do have hedging, but remember, they have a lot of debt from the Veren acquisition. Bonterra, 51%, not so much. Gran Tierra, 82%, not so much. And that's why their stock's at a 52-week high. Obsidian Energy, another one, 72%. Valeura Energy, 100% is liquids. 88% for Surge. They do some hedging, but quite a bit unhedged. So there's lots of opportunity. If I went to Hemisphere, 99%, and I don't think there's much hedging there. In place, 60%. Rubelite, 72%. So, these companies do have some hedges, but there's still a lot of upside from the unhedged portion.
All right, Joseph, time to move over to the natural gas stocks then. You keep on saying that you think that is the opportunity, especially the Canadian ones. Which ones stand out to you? Which ones, even on the other side, do you think you should avoid? Or is this simply a shotgun approach? But buy any natural gas stocks and ride them higher.
Well, I think you got to go to the ones that have the ability to grow, that will benefit from the LNG export market. So some of them have moved, some of them have not moved a lot. We're a big fan of Birchcliff. We've been for quite a while. You go to a Tourmaline, 77%, natural gas. So upside there. Vermilion is 69% natural gas, but they're already benefiting it from the high European prices. So the stock's run, and it's now at a 52-week high, 1686. It was a $7 stock, at the low in April of last year. So big move there. If you go to, domestic here, Cavi Energy, 80% natural gas. Pine Cliff, 81% natural gas. Pine Cliff was the only one that we had as a topic now in our last SER, because we think at these levels under 70 cents and lower, the stock is a bargain. Then you go to names like Petra, 65%, and then you go to 58% for Yangera. So there are names you can go after that are cheap. And, I think the key thing is nibble away on those. And, if you have overweighted oily names, take profits.
Joseph, we get a lot of questions about U.S. versus Canada for nat gas stocks or for oil stocks. So any thoughts there? Is there a preference of U.S. versus Canada for nat gas, U.S. versus Canada for oil stocks?
On the oil stocks, both sides have had a good run. So they've all done well. And if you compare the Canadian to U.S. names oily, I think you'd see similar kind of performance. Middle-sized oily Canadian names may outperform even the U.S. mid-sized oily names. The natural gas side, the Americans are getting a higher price. They're getting, $3.10, $3.15. I haven't seen the latest. So, we're only getting $1.80 in Canada. So the Canadian names have lagged what's going on in the States. And so people who've owned natural gas names in the States have done better. But if you look from here into a year down the road and the next 3 to 5 years, I think the Canadian natural gas names will outperform the U.S. names, because we're going to go from 2 BCF to 6-7 BCF. The Americans are going to of LNG. The Americans are going to go from 20 BCF to 30. So the Canadian growth rate will be much higher, and that's really the torque to make the Canadian price of natural gas run more from here than the U.S. NYMEX price.
All right, Joseph, we'll wrap it up here. Thank you very much for sharing your insights on, I guess, where the opportunities lie while this war in Iran continues, and trying to give us some, I guess, straightforward insights on the Strait of Hormuz. As I said, it's all very kind of opaque, if you ask me, in terms of the information we're getting, but it does seem like this war is very much continuing, and the Strait still seems relatively shut in. So we'll see if anything changes. But here and now, that's all we have for everybody. And that's all you have for us. So, Joseph, thank you very much for joining us on this weekend show. And again, you want to follow along with Joseph, check out the Schachter Energy Report or Ion Energy on Substack. I will post a link to both of those reports in the show notes. Everyone, stick around. We're going to be right back, switching our focus a little more to the metals sector and some of the moves in the metals prices.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
In mining, the difference between a good project and a great investment often comes down to one thing: visibility. Tara Hutton is a Sweden-based online mining investor platform built to make the invisible investable. Because a great project without a story is just data, drill results, spreadsheets, and technical reports that never fully connect. And a great project that isn't online might as well not exist at all. Tara Hutton brings mining projects into the digital spotlight, combining data, narrative, and context in one place, so investors can see not just what a project is, but why it matters. Whether you're evaluating early stage exploration or more advanced development assets, Tara Hutton helps turn complexity into clarity and information into insight. Visit Tara Hutton online and start discovering the stories behind the data. The dynamics of the natural resource trade changes every day. Get the full view of the commodity markets every week with Commodity Compass, hosted by me, Jennifer Pickrell. From metals to energy to agriculture, we break down the key moves, market drivers, and macro forces shaping the resource world, all in one sharp, insightful podcast from the Clear Commodity Network. Whether you're a trader, investor, or industry pro, Commodity Compass helps you stay grounded and informed. Listen on Apple Podcasts, Spotify, or at clearcommodity.net.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. Time to switch our focus over to the precious metals as we're chatting with Jeff Christian. Jeff is the managing partner at the CPM Group. And Jeff, I want to start off with gold, but we will get to silver as well. And it's actually a lot of the same topics we're going to cover here. But first and foremost, gold looked at as a safe haven. And as we talked about a whole lot in the first couple of segments, war in Iran is continuing. The oil price is moving higher. The gold price not moving higher, though. It's more or less just consolidating sideways. As we're recording this right around the $5,000 level, it is off of its highs of 5,600, but also off of its lows a couple days after that 5,600 was hit of 4,400, more or less right in the middle of, I guess, this wide range. So, Jeff, big picture, why is gold not going up when we have a war going on in the Middle East that doesn't seem like it's ending anytime soon?
I think the simplest explanation is often the right one. The simplest explanation is that gold had already risen in anticipation of the war and an ongoing worsening of the risks and uncertainties that the world is facing, not only with Iran and with oil supplies, but across a whole spectrum of things. And no one should have been surprised. The Iranians certainly were not surprised when the United States and Israel attacked them, because the United States has been saying they want to attack them for 40 years, and they have been much more militant about that. I mean, Dick Cheney wanted to drop a bunker buster on them in the final years of the George W. Bush administration, as did certain people within the Israeli Air Force, but cooler heads, including George W. Bush, prevailed. But since Trump has gotten back in power, he's been saying he's going to do this. They bombed it you had the so-called 12-day war where Israel and the United States bombed various sites in Iran. That was clearly ineffective, despite what the Trump administration said. So now they're going back to do more. And they're ignoring everybody's calmer heads and wisdom and So now we've got the Straits of Hormuz closed. But I think getting back to it, the gold price had already risen to $5,500, and that was partly reflecting the fact that everyone assumed that the United States was going to attack Iran. Yeah. So the price, and to be honest, the price of gold for the first time ever crossed $4,000 in like October of last year. So the idea that the price went from $4,000 to $5,500 and now it's trading basically around $5,000, the gold price already anticipated that war. That's I think that's the simplest and most logical explanation for why gold prices haven't risen even further.
Well, Jeff, we'll even dig into the nuances here. You just did a good piece and did a video on this topic about gold and oil and the correlation not being nearly as tight as many investors assume. And even in times of geopolitics, I think a lot of people figured there was some of it priced in, but then when the war has taken longer and it's extended, they expect it to keep moving higher. But maybe unpack some of the data you just shared with your members about the correlation between precious metals and oil not being that strong.
There are fundamental reasons why gold and oil should move broadly together, and broadly they do. But and those reasons are that when the oil price rises, oil exporting countries have a lot of excess cash coming in, and they're very profitable. And a lot of those countries, Middle Eastern oil exporting countries, Russia, they have a proclivity to storing their wealth in gold and silver. So when the price of gold rises, they have more money to buy more gold. So there should be there. In addition to that, when the oil price rises, it has inflationary implications for the industrialized world, and it sucks money out of other expenditures and investments. So it tends to lead to lower economic growth, weaker stock markets, weaker bond markets, and higher inflation, all of which lead other people in other parts of the world, the industrialized world, to buy gold as a portfolio diversifier. So there are real reasons to do that, but they don't move in lockstep together. On a nominal basis, the correlation between monthly or quarterly gold and oil price changes is around 21%. On an inflation-adjusted basis, it goes up to about 40%. But, again, it's not tick for tick. It's not dollar for dollar. There's a correlation. But I think that ultimately the big explanation is that gold prices anticipated what we're seeing.
So, Jeff, the one comment that everyone's making is that these higher energy prices, they are going to filter through to inflation. You brought up inflation there. What's a reasonable time frame to see this trickle-down effect of these higher prices into the inflation data? And then, who knows, maybe traders trading off of that.
Probably over the next 2 quarters. I would say 3 to 6 months is a period of time where you would see higher oil prices reflected in the higher costs of a variety of goods and some services. Big transportation costs, higher production costs. I mean, energy costs are the second largest component in mining costs after labor. So you're going to see higher costs for just about everything that you manufacture or that you transport, including, agricultural products. If you're shipping soybeans from Canada to China, you're going to put it on a ship, and that's going to burn a lot of bunker fuel to get that soybeans to China. So I think within 3 to 6 months, you see the inflationary implications of higher oil prices. And then the bigger question is how high do oil prices stay, and how long do they stay high? And that's a more complex question. I do not believe that you're going to see the oil price plunge back down to where it was 6 months ago or 3 months ago, $70 or something like that. I think you're going to see higher oil prices for a more sustained basis.
Yeah, Jeff, we've had a couple other commentators on the show make the same point that probably not going back to the low 60s anytime soon, but maybe some of it will ease off over the fullness of time. The other question is if there's still this geopolitical price built into the gold price. What happens if the situation does get resolved? How much of the war premium comes out in a truce or a deal?
In the gold price or the oil price?
In the gold, well, I think in both, but more particularly in the gold price, how much of that premium is still held in there? Is that what's holding it at 5,000?
Well, I think that, the war with Iran is very problematic, but it is actually probably a small part of the overall risks and uncertainties that the world is facing. And in addition to that, you see, even within the context of the Iran war, you see the Trump administration getting rid of sanctions on Russian oil, giving, in essence, a big boost to the Russian government treasury to finance the ongoing war in Ukraine. They also are talking, they are petition, the Trump Department of Justice wants to drop the charges on a Russian spy. So you have a whole lot of problems that are going to continue even if this war were to end. First off, I don't see the war ending. For Mr. Trump to say that this war is going to be over quickly is reminiscent of Putin saying, "Oh, we'll be able to take over all of Ukraine in 6 days," or Brezhnev saying, the Russian and Soviet invasion of Afghanistan in December 1979 is a short-term military occupation. It lasted a decade, and it literally was the single most important factor destroying the Soviet government. All of those troops coming home hopped up on heroin and opium, and the dissolution that they and their families had, that was probably the biggest factor that led to the collapse of the Soviet Union. And then you also have the United States invasions of Afghanistan and Iraq. And Iran is the biggest and best armed country within the Gulf region. So I don't see this thing ending anytime soon. So I think it's going to continue to be a problem. What the war premium is in gold, maybe it's $1,000, $500 to $1,000. It's hard to say because there's so many other problems, from debt and deficits to lower employment and weaker economics to higher inflation. There's so many other problems that are behind the 5-year gold bull market that we've seen. I don't see that the resolution of this war would have a major negative effect on the gold price. You take off $1,000 off the gold price, you're back to where we were in January.
Yeah, that's the crazy thing about how fast gold has moved. And yeah, the world, in all fairness, it does seem like a mess. There's a war in the Middle East. There's the ongoing war in Europe over Ukraine. Mexico, we just keep getting bad stories about there. And that's not really a government thing, but that is cartels fighting with each other. It's a very scary world out there. And look, the gold price is clearly shot up. It went almost vertical last year. And look, you said a 5-year bull market. People can go the whole way back to over 10 years ago when gold was just at $1,000. But I want to ask you, in terms of investment demand, what are you seeing out here? Because look, gold is consolidating sideways. The stocks, those are having a very tough month. As we're recording this, GDX is off almost 20%, and it is almost back to where it started this year when you consider just how well the stocks did in January as a follow through for all of last year as well. It does seem like we've lost a lot of momentum, and there was a lot of momentum behind the gold and gold stock trade last year and even the first month of this year. Where do we stand now in terms of who's playing this market, or quite simply, how many people have turned away and are sitting on the sidelines?
Yeah, I'm going to say something that will confound certain people. and it has to do with time. One of the things that we've seen right now over the last couple of weeks is we have been seeing some investors take profits from recent short-term investments. And, the gold price surge that you talked about, and that I talked about, really, starting in October, November, December, January, and continuing, that was fueled by a combination of long-term traditional gold investors and silver investors and an influx of non-traditional short-term opportunistic investors, people who poured into the gold ETFs and the futures and options markets and buying some physical metal. And what we're seeing is a lot of those shorter term people are taking profits or standing aside. And a lot of the longer term people are also standing aside. They're not continuing to buy. They're waiting to see how low prices might go. So we wouldn't be surprised to see the gold price and silver price fall over the next week or so. And if that happens, we expect some of those long-term investors to come back in as buyers. But one of the things that you're seeing on an ultra short-term basis is, you have some investors taking profits and you have a lot of other investors standing aside waiting for lower prices to re-enter the market. Now, that's the ultra short-term. On a longer-term basis, there are all these other investors who are saying, as we were just talking about, massive risks and uncertainties, incredible levels of investor and consumer and business executive and government anxieties. So you've got a long-term situation that suggests that the gold price will continue to be high and probably rise further. And our expectation is that investment demand will rise further this year and next year from where it was last year. But on the ultra short term view, you could see a pullback before you see that renewed surge in investor demand.
Well, Jeff, let's carry this over into silver. Just like gold is hovering around 5,000, silver went on a rocket ship ride to 121 on the futures, dropped down to almost $64 on the futures, has settled out somewhere in between that range, really hovering on either side of 80, in the high 70s or the low 80s. What do you make of this price? Does it need to drop down to bring in that buying just like gold? Where are we at with silver?
I think it's a very similar thing. You've got long-term positive, for silver price and investment demand. Long term, you've got a lot of negative economic and political factors that are keeping investors interested in it. But short term, you have some profit taking. You have lower fabrication demand, actually, for both gold and jewelry and in silver in a number of applications because of the higher prices, because of the economic uncertainties. And then you also have some technical factors. So you're seeing investors being much more cautious, really actually starting in January for silver. Even as the silver price was rising, you saw like ETF selling. So investors were selling silver ETFs in January, even as they were buying gold ETFs. But that has kind of reversed now. So you've got investors sort of thinking that, the silver price probably has to come back off, maybe to $70, maybe even lower. And then we would expect to see bargain hunting resume because longer term, the economic environment and political environment suggest that you should have more of your wealth in gold and silver than you used to.
No, we've definitely heard a lot of well-known investors actually start to say that and reallocate some of their portfolios to that. But Jeff, on the whole, I guess, risk-free value of silver because of its industrial uses and because, well, it just seems to be a smaller market. It can go vertical and it can also come crashing back down. Silver production is also very much a byproduct of a lot of different mines. How do we even put a number on what the risk-free silver price of silver is, or even what the general cost of production of silver is?
Yeah, we calculate a theoretical risk-free price for gold and for silver. And they're theoretical because, I've only been in the business for half a century, and I've never actually seen a risk-free environment. I've seen environments where the risks were extremely low, or investor perceptions of the risks were extremely low. So with silver, from 1990 through 2005, the silver price basically traded between $3.50 and $5.50 an ounce. Now, that was sort of a risk-free price back then. If I look at the silver price today, you know, the average cost of production for primary silver is around $11 on a cash cost basis. On a full-in basis, it's probably around $20 an ounce. Now, that's only accounting for about 28% of mine production. The other 72% is byproduct, and depending on how the producers do their accounting, you can argue that a lot of that byproduct has a production cost, full-in production cost of, $2-3 an ounce. So mine production is very cheap, very low compared to where we are now, and so too is secondary recovery from scrap. So you can say, well, what's the risk-free silver price? And say, well, a risk-free silver price would be what is the price of silver that clears the market, supply and demand, if investors are not present in the market. They're not buying silver the way they have been the last 5 years, but they're also not selling silver the way they have from 1990 to 2005. And you can say, what's that risk-free price? And it's probably around $20 an ounce. So you have to think about the mine production, the marginal cost of production, which is the primary producers, all-in cost probably around $20 an ounce, and fabrication demand. At $20 an ounce, you'd see renewed fabrication demand. You'd see more people buying. You'd see more jewelers making silver jewelry. You'd see more people buying silver jewelry and silverware and silver statues and stuff. You'd also see more use of silver in architectural glass. You might see a further increase in silver use in solar panels, which have been the big growth story for silver fabrication demand over the last quarter century. But with the higher price, you're starting to see substitution and a reduced per unit use. You'd start seeing greater fabrication demand for silver, and you'd probably, see that. So the risk-free price of silver is probably around $20 or $25 an ounce.
Well, Jeff, that's a pretty big delta between $80 and let's say 25. So where do you see pricing settling out? Because like you say, it's never really totally risk-free. What's a fair price for silver then, somewhere between those two?
For me to say the silver price, for me to expect the silver price to fall back to something like that, I would have to be convinced that we'd have incredibly better economic and political situations. And I don't see that happening. I see the economic and political problems that really have been, it's not the last 4 years, it's not the last 8 years, it's the last 60 years. Yeah. And I see a market clearing price in an improved economic and political environment on the order of $45 to $50 an ounce, right? Maybe $55 as a nominal price and $50 or $47 to $50 on a real inflation adjusted price. That's where I see the price shaking out over the next several years, assuming that we get into at least a cyclical improvement in the economy and the political environment. That would require a resolution of the Russian invasion of Ukraine. It would require a cooling off of the wars in the Middle East, which have really been going on since the late 1940s. It would require some reduction in the tensions in East Asia and Southeast Asia between China and all of its neighbors. And it would require greater fiscal responsibility, not only on the part of the United States government, but on the part of other governments and on the part of consumers and industrial users, all of which comes down to higher interest rates. So a better return on interest-bearing assets. So it would have to be a much better economic and political environment for the price to fall as low as $55 an ounce.
Jeff, what was happening, let's say 11 years ago when gold was down at $1,000, $1,100, and we were hearing that the cost of production was higher than what the actual metals price was, but yet we kept seeing companies produce gold. Mines weren't just nonstop shut in, obviously, because it's hard to shut in a mine. But I know there are people that are always looking at the underlying cost of production for especially something like gold that isn't really used and wondering and understanding that production costs do continue to rise, but the metals price has continued to rise. That when in history, or what does history tell us when the market price matches or is really close to the cost of production, which we're nowhere close to right now?
Yeah, if you go back 11 years or whatever, my math is kind of screwy. But yeah, 2015 to 2018, the all-in sustaining costs on about 85% of world mine production were down around $900 to $1,000. And the market price did fall to like $1,080 or $1,040. So you still had, on average, profitable mining, but the margins had contracted to virtually nothing. And you saw mine production fall. You saw mining companies suspend, in some cases, totally suspend their exploration, their greenfield and brownfield exploration programs. You saw them slashing their overhead and their central office things. So you saw the cash costs hang up relatively high because they are stickier. But you saw the sustaining costs, the exploration, the mine development, the central office stuff. You saw those prices fall, those costs fall very sharply. But you still had a small profit. And it was such a small profit that you saw mine production fall. But, that was at $1,000 an ounce. We're not there, and we're probably not going to be there for a long, long time, if ever.
Well, Jeff, there's such a delta now between the cost of production and where they're selling it for that these are the fattest margins the industry has ever seen.
Yeah.
Now, with oil prices creeping higher, that's going to eat into it a little bit. But even if oil prices do creep into it, they're still the fattest margins anybody's ever seen. What does that mean as far as the ability to potentially step on the gas and produce more gold? There's a lot of companies we talk to racing to do a bulk sample or racing to get small scale production going. The big miners can lower their cutoff and bring stuff in that's been sterilized for a decade. What does that mean for an increase in production?
Yeah. If I always like to say in 1980, when the gold price spiked up to $850 and came down, it averaged like $612 an ounce. It was very funny because the major mining companies, and 72% of the world mine production came from South Africa at the time. The major producers said, we cannot produce gold at these levels. And they were right. But the mine production of gold went from like 30 million ounces to about 70 million ounces over the next 10, 15 years. And all of that production, or virtually all of that production, came from companies that were not gold mining companies in 1980. Yeah. But with the gold price higher, you had gold production in the United States less than 1 million ounces in 1980. You had one major gold mine, Homestake Gold, one major mining company, Homestake Gold, in the United States. I think that Australian production was less than 1 million ounces. You had mining companies up on the ropes around the world, but you had a whole branch of new companies. As Peter Monk said, I don't believe in gold, but I saw the margins that were there in 1980, 1981, and I said, I've got to get myself a gold mine. And he created Barrick Gold Mining, which became one of the largest gold mining companies within 18 years. And you had this tremendous growth in mine production from companies that were not gold miners in 1980. You are starting to see the beginning of that now, again. And you will see mine production increase in the long run. It may take several years to start emerging, but it's there. And as you said, yeah, you'll see existing gold mining companies increase their production, revive some old mines. You'll see a lot of old mines that will be revived again. We've been looking at several companies that are picking up old gold mines and rehabilitating them. So I think that will continue, and you'll see new properties because there are enormous reserves and resources for gold and silver to be mined that can be profitably mined at prices much lower than we expect them to be over the next decade.
Oh, what a trend that has been. Going back to these old mines, trying to start them up, and even taking over some mines that, quite frankly, bankrupted other companies, now getting quite a bit of value in the market. One more question, though, Jeff. This weakness in some of the share prices, but still strong economics for the producers. A lot of the juniors and mid-tiers have come off. We even heard during some of the earnings calls from the major gold miners that they might start looking at M&A. Is this the time where we are going to see M&A from the majors pick up further down the food chain?
Well, first off, I'm optimistic about gold share prices and silver share prices for a lot of newer companies. The majors in the gold market have a big problem in that they always buy high. So when the gold price rises, I'll tell you an anecdote. Do we have time for an anecdote?
Lay it on me, Jeff.
The Barrick management in the mid-19s, they went to the Denver Gold Group and they gave a speech. They said, we're going to spend $2 billion or something and buy back our hedges, and we're going to be unhedged. I left the Denver Gold Group a day early because I wanted to come to New York, where the Canadian American Chamber of Commerce was honoring Peter Monk, who had created Barrick and had moved away from it. And at that luncheon in New York, somebody asked Peter, he said, you created Barrick in '83, and it's now like one of the two largest gold mining companies in the world. But other people created like 30 some odd other gold mining companies, and they failed. Why did you succeed where they failed? And Peter said they didn't fail. They were all successful mining companies. And in fact, over the last 20 years or 25 years, whatever it was, we have bought 27 of those mining companies. And we were able to do that because A, I don't believe in gold, and B, we hedged. So when the gold price would rise, we would put hedges in place. And I know personally that at one point they had about 10 or 12 years worth of production hedged at extremely good prices in ways that gave them blue sky if the price kept rising, but gave them protection against lower prices. But Peter said, we hedged, and those other companies would go to their banks, borrow as much money as they could at the higher gold prices, and then spend it buying other properties. And when the gold price fell, they were in financial straits, and we had these massive hedge profits that allowed us to buy them in their financial constraints. That, I'm afraid, will happen again. You have major gold mining companies that will buy high and through mergers and acquisitions at the top of the market. And that will that will continue. In silver, it's slightly different. I think that there are some major silver companies that wish somebody would buy them, but the larger diversified mining companies are not interested in buying silver mining companies at this point. So I think that it's a different situation in silver, but both in gold and silver, our view is that you look at the exploration, the pre-development, and the development, and the mid-tier companies. And the mid-tiers will do well because, as I said, the majors will come in at the top of the market and pay a high price to buy those mid-tiers to shore up their reserves.
All right, Jeff, we will wrap it up here. That was a lot to get through and very interesting to talk about this market that, look, I get still longer term looks great, should be great, but right now going through a bit of a consolidation or a little weak period, and the stock's struggling as well. We'll see when that all turns around, but there's just so much going on in the world right now that it's almost hard to make sense of it all. If you want to follow along with Jeff, just search CPM Group or click the links in the show notes on our website, podcast, or YouTube channel. All you have to do is search the KE Report, and that's where you can listen to this full weekend show, all our daily editorials and company updates from throughout the week. Everyone, thanks for tuning in to this weekend show. Jeff, thank you for your time, and I hope you all have a great rest of your weekend.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.